On March 1st, U.S. two-year yields were trading at 1.37%. Fast forward 5 weeks later, and that yield is now 2.51% as prospects for the Fed tightening have increased. Market expectations are now for 50 basis point rate hikes at each of the next 3 Fed meetings. Of course, this comes after CPI data has confirmed the highest level of inflation in 40 years, with the markets anticipating that the April 12th reading of CPI will likely show another increase up to 8.3% year over year. Even as expectations rise, there are signs that the market believes that the Fed may be too aggressive. An inversion of the 2-year versus 10-year spread suggests to some that the Fed potentially could be overdoing hikes and cause recessionary pressures. This all comes against the backdrop of geopolitical unrest, an energy crisis in Europe, skyrocketing domestic gas prices, and wage growth that has not kept up with inflation for the last 8 months consecutively. Now, if a trader believes that the Fed will remain resolute in their singular focus on inflation, and that consequently 2-year yields may rise further, they could express that by buying the April micro 2-year Treasury yield futures contract at a current level of 2.55 and target the summer of 2018 highs at 2.70. A stop could be placed for this trade at 2.45, just below support levels from early April. This trade could make $150 if your target is reached and risks $100 if you're stopped out at your level. Now, if a trader believes that the 2-year yields are headed lower, perhaps from increased recession worries, they could express that by selling the April micro 2-year Treasury yield futures contract at 2.55 and target the March 31st lows at 2.33. A stop for this trade could be placed at new recent highs of 2.65. This trade could make $220 if your target is reached and risk $100 if you're stopped out at your level.